I speak quite often on the channel about purchasing rental real estate with mortgage loans in order to leverage my money up and have more capital working for me in the markets in order to reap higher rewards both in the short and long term. Case in point, in my recent video about how I achieved a 400% ROI on my last duplex transaction, well, that level of ROI in such a short time frame honestly would not really have been possible had I just purchased the property in cash and not used any loans whatsoever to finance the property. But here's the thing, there's a strong difference between using a debt capital in order to leverage my funds into a real estate transaction that I can accurately calculate my returns on and control hands-on than using leverage in the stock market with something called margin or through leveraged ETFs, which inherently come with a much higher level of volatility and risk. But if leverage is so powerful in the world of real estate, allowing investors to achieve significantly higher returns on investment, then why is this any different with paper assets? This is the question that we're going to attempt answering in today's video. Hey, what's going on, savers and investors? I hope you're all having a great day as always. If you're new here, then welcome. My name's Griffin, and on this channel, we speak about all things investing, from specific stock market concepts like in today's video, specific company analysis, and even how you can get started investing in real estate. So if you're looking to grow your wealth through investing, make sure to subscribe to the channel and hit the bell button so that you're notified whenever I release new content. In today's video, I decided to take a step back from all the specific technical company analysis content that I've been releasing lately on the channel in order to circle back to some basic stock market investing concepts that some viewers have actually asked me to speak upon over the past couple of months, specifically for today's video, leveraged ETFs that I've actually never spoken about on the channel, even though we speak quite often about exchange traded funds and their use in stock market portfolios. So in the video, we're going to be speaking about what leveraged ETFs even are in the first place and why they're utilized by some investors, followed by some risk associated with utilizing leveraged ETFs. And finally, we'll end this video with my final thoughts on the use of leveraged ETFs in my own portfolio and whether or not you should consider utilizing them in yours. All right, so before we jump into the thick of leveraged ETFs, I first want to take a minute or so here to speak about using margin in an investment account. For those of you who may not be aware or hearing this for the first time, margin is the term used in stock market investing to refer to debt capital. On the flip side, in real estate, typically debt capital is referred to as mortgage loans, as well as a couple other products like home equity lines of credit. Now, depending on your financial situation and the brokerage that you use, most brokerages are going to allow you to use margin in your cash margin account, meaning they will lend you funds that you can borrow in order to invest and leverage your capital up to hopefully reap higher returns. And the use of margin is not permitted in registered accounts, meaning the TFSA and RRSP in Canada, as well as the IRA and Roth IRA in America. Now, I don't want to turn this video into the pros and cons of using margin in your investment account because this video is about leveraged ETFs, but everything kind of all ties together here. With that said, when you're using leverage in a stock market portfolio, keep in mind that interest must be paid on these borrowed funds, because just like when you go to the bank and request a loan, you need to pay interest on that loan that you've taken out and utilized. So that's definitely something that you need to keep in mind in your overall returns on leveraged up investments. Another thing to keep in mind when using margin in your stock portfolio is that if the market does happen to go down and your position is in a position of loss, well, the brokerage is actually able to do what's called a margin call, where they're essentially requesting that you pay back all the borrowed funds that you borrowed from them. So in this particular case, if you don't have the funds elsewhere in order to cover your loss here and pay back the loan, the brokerage is actually allowed to sell your stocks and other positions, even if they're in a position of loss, in order to pay back this loan. Think of how crazy that is. In contrast, if the housing market went down and your tenants are still paying for rent and you're paying all of your mortgage payments on time and everything, nothing is actually going to go wrong here because you can just hold on to the asset, ride through the market cycle, and call it a day. However, with stocks, if you're using margin and the market goes down, this is a really bad thing because the brokerage can do a margin call. But above all, the point I'm trying to make here is that when you're using margin, yes, your gains are going to be amplified, but so are your losses. Quickly, here's what I mean by this. So let's say you have $50,000 to start investing with, and this is your own equity capital, and you decide to put it in a certain stock that gives you a 10% return in year one. Well, great, you now have $55,000. And on the flip side, if you lost 10%, you would now have a value of $45,000. But what about if you're leveraging up your money by 100% using margin in your stock portfolio? Well, in this case, you would have your $50,000 worth of equity capital and then your $50,000 worth of margin for a total combined by an amount of $100,000. At this point, if the market went up by that same 10%, well, you would now have $110,000 in your account. But on the flip side, if the market went down by 10% also, you would have $90,000 in your account. But here's the thing with margin, you still have to pay back that $50,000 that you borrowed from the brokerage account in order to leverage up your funds. So once you've paid back your $50,000 in margin, you're left with $40,000 here. And this doesn't even take into account the interest that you paid on your borrowed funds. All right, so honestly, we could speak a lot more about the technicalities of how margin is going to impact the returns of a stock portfolio, but I really just wanted to pre-frame this video with speaking about what margin is and how it works, because this is going to be really important in properly understanding how leveraged ETFs work. For today's video, that's really all I wanted to cover regarding margin. If you have any thoughts and opinions though, let me know down in the comments, and let's now get back to the actual topic at hand, which is leveraged ETFs. Alright, so let's start with what leveraged ETFs even are, in case this is a new concept for you. As the name would suggest, a leveraged ETF is a type of exchange traded fund that you can still buy and sell shares of on a stock exchange just like any other ETF, but the difference lies in the fact that instead of tracking the securities of the underlying index in question on a one-to-one basis like any regular ETF, well, the goal of a leveraged ETF is to use certain financial instruments in order to achieve a higher than expected daily returns for a given market index. Some leveraged ETFs will aim for, say, 1.25% the daily returns of the underlying index, while others will aim for, say, 2 or even 3 times the daily returns of that underlying index. And what's most convenient about leveraged ETFs is that you don't actually have to use margin yourself in your own portfolio requested from your brokerage in order to achieve the leveraged results of a leveraged ETF. Now, the way that a leveraged ETF even achieves these 2 to 3 times daily returns of the underlying index anyways is by utilizing a variety of financial instruments such as futures contracts, options, and equity swaps in order to go and get that extra boost in appreciation above the underlying index, while also holding a healthy portion of the assets in question that this underlying index is tracking. Because think of it, how would the fund actually be able to achieve 2 or 3 times the daily returns of the S&P 500 or NASDAQ 100 without using leverage within the fund itself by using futures contracts and equity swaps? This is essentially the way that these funds are able to achieve these excess returns, but it does come with a price. And I want to make this very clear that the goal of a leveraged ETF is to create those excess returns for one single trading day, because after every single trading day, there's new futures contracts and equity swaps that are utilized the next day in order to achieve this leveraged effect again. The main dangers associated with leveraged ETFs surface when an investor doesn't necessarily fully understand the extent of what they're investing in and decides to hold the leveraged position for more than one single trading day, which, remember, is the goal of the fund, to create excess returns on a given one trading day. So at this point though, even with the potential dangers associated with leveraged ETFs, they seem pretty awesome, right? And for the most part, they actually can be great tools to grow your overall portfolio in a rather quick period if you use them with caution and fully understand what you're investing in. But if leveraged ETFs allow you to achieve 2 or 3 times the returns of an underlying index, then why would you even hold the broad market ETF like HXQ, which is a NASDAQ 100 ETF offered by Horizons Investments, which already produces nice gains, when you could go ahead and purchase their HQU ETF, which is a double leveraged NASDAQ 100 ETF, and reap double the rewards? Well, unfortunately, there's always a flip side to the coin, because otherwise everyone would be utilizing this strategy and achieving 10, 20, 30% returns every single year and flying around in private jets in no time. On the surface, the returns generated by a leveraged ETF can actually be quite confusing, especially for new investors. For example, if we look at the chart of HQU, which is the Horizons 2X Daily Bull ETF, meaning it has the goal of producing double the returns of the NASDAQ 100 on any given day, it looks like over time your investment would be achieving absolutely stellar returns. But just looking at a stock quote does not take into account the compounding effect of positive and negative returns on your investment. This is actually a concept that a lot of investors, especially new investors, fail to fully grasp, making things really confusing. With this in mind, on a day when the markets are in fact green, your strategy would pay off in that you would create 3 times the returns of the underlying index that this leveraged ETF is tracking. The issue lies in the fact that on days when the market is not trending green and you happen to have held on to these leveraged ETF positions, well, your losses are also going to be leveraged on these positions and therefore compounded into into far greater net losses on your invested capital. This means that even on a day when the markets are up following a day when the markets are down and you've held a leveraged ETF during this entire position, chances are your returns are going to be lower than what your returns would have been on the one-time leveraged ETF, meaning an ETF that is not leveraged whatsoever in tracking that underlying index, because the reality is that it takes a significantly higher percent returns to cover for smaller percent losses. If this sounds overly confusing, honestly, I totally get it. So let's look at a comparative example of an investor who would have invested $1,000 into both a non-leveraged ETF and then a triple leveraged ETF in order to see how things would differ on the exact same trading day sequence. So let's say you're starting off with $1,000 invested into a triple leveraged ETF, and on the first day of your investment, the market is having a great day and it's up 10%, meaning the underlying index would be up that 10% for a value of $1,100, and then your leveraged position would be up 30%, which is fantastic and is the goal of a leveraged ETF anyways, placing your investment at $1,300 in total value. The issue with this strategy then sets in if you decide to hold on to the ETF rather than selling and materializing your gains in that short period of time, and the markets happen to tumble down the next trading day or just subsequently thereafter. On day 2 of your trading, let's say that the market is down 10% again for the sake of this example to showcase how leverage works both in your favor and against you. Well, in the case of the underlying index, the investment would practically be back up to par at $990 in value, while the leveraged position would actually be significantly lower than where you started at $910. And I just want to take a second here to highlight the fact that the underlying index, which was up 10% yesterday, was at $1,100, and then the next day when it's down 10% also, it's not at 100% par, which would be $1,000, it's at $990. This is what I meant earlier when speaking about the fact that it takes a higher percent gain in order to cover for a lower percentage of losses. Now let's say that on the next trading day, the markets decide to go up again another 10%. Crazy market to be investing in, I know. So in this case, the underlying index would go from $990 in market value to $1,089. And then on the flip side, the triple leveraged ETF would go from $910 in value to $1,183. And finally, for this example, let's say that once again on the 4th trading day, the market tumbles by 10%. Well, for the underlying index fund, the market value would go from $1,089 to $980.10. However, for the triple leveraged ETF, things start to get dirty here with the value of the investment falling from $1,183 to $828.10. The reason why the value of the investment for the underlying index isn't fully back up to par at $1,000 in value is as a result of compounding of the returns, which we're not going to dive into right now, but essentially, as I said earlier, it takes higher gains to make up for the same percentage in losses. And the same would be true to leveraged ETFs, it's just that this time things are amplified by 2 or 3 times depending on the leveraged fund in question. With this in mind, what exactly would be the use of a leveraged ETF then? Because obviously they have a purpose, otherwise they wouldn't offer them. Well, the idea here is that leveraged ETFs be used only for short-term holding periods, because otherwise, if you're holding on to these leveraged ETFs longer than only a couple of days, the double or triple leverage factor can be severely detrimental and eroding of the gains that you've materialized on this position. For long-term investors, it's absolutely critical that you do not get fooled by the stock charts of these leveraged ETFs and rather opt for traditional index funds that aren't leveraged to achieve more steady and consistent returns over time. In addition to this, the equity markets are more volatile than pretty much ever before, so no matter who you are, it's pretty much impossible to accurately predict whether or not the markets are going to be red or green on any single trading day, and even less on a period of multiple trading days or weeks. So again, I just want to reiterate here, because I've had multiple viewers ask me whether or not utilizing leverage ETFs ETFs long term would be a great strategy, because they're just looking at the stock chart that looks absolutely unreal, the gains that are being achieved here. It is not going to be a strategic move to hold leveraged ETFs in a long-term buy and hold stock market portfolio. All right, so with everything that we just covered, what are my final thoughts on the use of margin in a stock portfolio and leveraged ETFs? First of all, I'll just mention it right now. I actually do not use margin in my stock portfolio because I just believe it carries inherently a higher level of risk than I'm comfortable with. I'm definitely a strong believer in using leverage for real estate transactions that I can accurately calculate my exact return on investment on and the cash flows associated with that specific deal. And I'm going to continue using leverage on real estate transactions moving forward, but using margin on stock investing to me just carries too much risk with margin calls and leveraged losses, especially during an extremely volatile market. In fact, this is something that I've personally believed for a while now, using margin for stocks instead of leveraging money on real estate transactions. And funny enough, a recent video posted by Graham Stephan where Kevin O'Leary reviewed his entire stock portfolio, he didn't seem too keen on using margin for stocks either. In fact, here's what he had to say about using margin for stocks.
Never use margin in stocks. Never.
Wait, what's that, Kevin?
Never. Never, never, never.
Back to leveraged ETFs though, another thing to consider on top of the inherently higher risk investment here is the fact that leveraged ETFs also come with significantly higher management expense ratios over, say, passively managed ETFs that are just tracking an underlying index, because with leveraged ETFs, we actually have fund managers here that are constantly buying and selling positions in order to rebalance the portfolio and reap those 2 or 3 times daily returns of the underlying index. All right, so with everything that we just covered, if there's one thing I want you to remember here, it's that leveraged ETFs are designed to create 2 or 3 times the returns of a specific underlying index on one individual trading day. So if you're a long-term buy and hold investor like I am, and you're utilizing the strategies that we speak about on this channel, make sure that you properly understand what leveraged ETFs are, how they work, and make sure to never hold them for a longer period of time than one, maybe a couple days maximum. I really hope you enjoyed today's video, and for everyone who requested that I speak about leveraged ETFs, I hope that this content was valuable to you. If it was, please take 2 seconds to drop a like on the video. That's all I really ask in return, and it really helps my channel grow. If you're also interested in learning more about stock market concepts as well as specific company analysis videos and real estate investing, then make sure to subscribe to the channel and hit the bell button so that you're notified whenever I release new content. On that note, thanks a lot for watching today's video on margin and leveraged ETFs, and I'll see you in the next one.